Joining me now to discuss is Dan Greenhaus of Solus Alternative Asset Management and Stephanie Link of Hightower Advisors. Stephanie's a CNBC contributor. It's good to have you. Dan, I'll give you the first crack at this since you're sitting right here. I mean, he obviously wishes his words, the professor, they came out differently than they did Monday morning a week ago when he said the Fed should do 75 basis points in an emergency cut. Sticking, though, to his point that the Fed's too restrictive now and they need to cut.
Sure. And listen, two things can be true at once. The Fed, as Jan laid out in the previous instance, that 5 3/8 is probably too high of a rate for the economy at this point in time, and some cuts should be put into place. Can be true at the same time that there was a panic in the market on that Monday, emphasized perhaps most acutely by Jeremy Siegel calling for not just a 75 basis point emergency cut, but an additional 75 basis point at least at the subsequent meeting, so a total of 150 basis points immediately. And again, not that Jeremy Siegel was alone. There were some people that were quite hyperbolic at that moment. But two things can be true at once. The rates are too high, and calling for that level of rate cut was a bit hyperbolic.
And Steph, here we are having this conversation with the Dow back at 40,000. We're pretty much at that level as we speak.
Yeah.
Unbelievable comeback. But now what?
Well, I think the volatility is here to stay, especially in the next 2 months, because we are at the seasonally weakest period of the year. So I wouldn't be surprised to see some back and forth. But, Scott, you have to just back up. Last Monday was the yen carry trade on wide. It was not a credit problem. And the economy is still growing. I don't know. Is it 2.9 according to the Atlanta Fed? Maybe not. Maybe it's 2.5%. ISM services is a huge part of our economy. It's doing quite well. Not only that, new orders and employment within that report was very reassuring. And so you add it all up, and we just put up 11% earnings growth. And when you're putting up better than expected earnings because the economy is hanging in there, I mean, there's no reason for emergency cuts. And I'm not even sure you're going to see 100 basis points, like Hatsias was saying, between now and the end of the year. The 25 or 50 in September, it's all going to depend, obviously, on the labor market because we have made enormous progress on inflation. So let's watch the labor market. But, Scott, the weekly jobless claims, 4-week moving average, is at 240,000. And I remind you, and I remind all of the listeners and viewers that 350 to 375,000 is recessionary. So I understand and appreciate we have seen a gradual increase in weekly jobless claims, but it is certainly not in a dire situation for a lot more cuts than 50 at the most in September.
I think Hatsias said 75, not 100. 25, 25, and 25, just so we're on the same page.
Okay.
Dan Greenhaus.
Okay.
A buyer here or a trimmer of the market? Rick Reeder making the point yesterday that, his view from last Monday to yesterday had changed on that question just simply because of the comeback.
Yeah, and listen, I'm probably closer to Rick in the sense that, well, listen, let's start with the economy is not racked with pestilence or the plague. Everything seems okay to Stephanie's point. The ISM services came out okay. Jobless claims have been ticking up, but the commentary from companies outside of the low-income consumer have been okay. We're going to have Walmart tomorrow, which will be obviously crucially important in addition to retail sales. That's right.
Claims.
So there's other data that will help color this in, but nothing in the near term appears suggestive of an economy that's collapsing on the order of 150 basis points of immediate rate cuts. So, but with that said, and to touch on a little bit of what Rick got at, and as a reminder for the viewer, Steffi and I were here that day having this larger conversation. You can make a case that the equity market feels a little top heavy again, and that from an investment standpoint, there are opportunities, better opportunities to be realized outside of those top heavy names, with the caveat, of course, that argument for the better part of 6 months has not come to fruition.
Steph, you've been more a buyer than a seller of stuff. In fact, more so than many who have come on the network. And, last week you added to Eaton, Lamb, Energy Group, Bank of America, Truist, Amazon, CrowdStrike's a new position. But juxtapose that versus what Rick Reeder is saying, that this is a little uncomfortable because it's happened so fast. And now we're here talking about, as Dan said, top heavy, valuations expanding. Do earnings really justify all of it? Does the slowing economy justify all of it? How do you answer that?
Well, I think you've had a big bounce back in the Mag 7 and in large cap tech, and also in growth. all the names that I added to actually really haven't participated as strongly as that other group. So I think that there are always going to be opportunities, those stocks that have lagged. And the good thing is we just got earnings from these companies. We just got guidance from these companies, and it was really good. Every one of the names that I bought, they beat and they raised, and they had decent things to talk about in terms of just the overall environment, including Brian Moynihan at Bank of America. If he's going to see something falter, he'd be the first one to see it, and he's not. So to me, I think there's a lot of opportunities in the kind of non-tech, if you will, or Mag 7-ish, and it goes back to what I just learned over the last couple of weeks during earnings season. I think, again, I go back to stocks sold off, and they sold off huge, not because of a credit problem. If it was a credit problem, it might have been a different story in my book in terms of adding.